Hi, this is Alex Mozed. We're here on Winner Take All, where we talk about modern monopolies, tech regulation, and how do you capture these network effects that every investor is trying to figure out how to capture and take advantage of. We've got a really great schedule for you today. We're going to talk about Uber and Lyft earnings. Those are coming out tomorrow and Thursday. Lyft first, then Uber. We're going to talk about B2b Food Service platforms and what's going on in the food service world with the likes of Cisco and US Foods and these kinds of places. We're going to talk about some platforms that you may not be familiar with, like the Fed. What does the Fed do as a platform? A few things, actually. We're going to talk about StockX and GOAT in the sneaker resale marketplace, these niche vertical specific marketplaces that are growing like wildfire, and StockX was just hacked. Also, looking at B2b distribution for linear health distributors like Cardinal Health bragging that they have 300,000 products in e-com. Sorry, you shouldn't be bragging about that. And then Amazon Go and what's going on with this cashierless checkout arena, looking at food in now the retail grocery store environment, and who is going to now try to compete against Amazon Go in the retail arena. So let's jump on in. I'm joined by Nick Johnson, co-author with me on the book, Modern Monopolies. And so now Uber and Lyft have recently gone public in the past few months. They are going to really have kind of their first earnings release coming up in the next few days here. And Uber is going to take a big write down for really just the cost of the stock that they've now issued. And so that's a one-time thing that doesn't materially affect the actual business. Let's jump into the numbers here because there's a lot of different numbers. But ultimately, I think what people are trying to figure out is what kind of winner-take-all market is this? I think everyone says, yeah, Uber and Lyft ride sharing, it's a winner-take-all market in the US. I think what people are asking themselves, if you're an investor, you're trying to say, is this more like iOS or Android, where it's kind of like a 50-50 split and the two dominant players are more close to one another in their dominance? Or is this more like Google search and Bing, right, where Google has 70-80% market share, and then the second player is a far less superior second player? Still both winner-take-all markets, but a very different composition of them. How would you kind of break down the dynamics of this? How do you kind of look at the ride-sharing market, Nick?
I think the challenge for ride-sharing is, I think the CEO of Lyft may have said this at one point, is basically once you get to availability down to about 3 minutes, then the additional network effects from there sort of diminish. Really, if you can get someone a ride in any area, then a few minutes going from 3 minutes to 2 minutes and 30 seconds isn't much of a difference, and not one that makes a material difference. So I think that if you're looking at ways that this might not be a winner take all and where they might be able to get close to each other, it would be in those areas where they can both get basically similar levels of capacity and supply, such that they can both kind of reach that sort of threshold where that might kind of attenuate the winner take all dynamic.
Yeah, and I mean, Uber now isn't just one platform. They are becoming a platform conglomerate. They have obviously Uber Eats, which you can see here. Uber Eats in their most recent quarter accounted for about 21% of the core platform gross bookings. So this $14.5 billion in GMV is split about 20% Uber Eats, 80% ride sharing. Also, if we scroll up, this is from the earnings release. All gross bookings are about $14.65 billion. Basically, that other $140 million in GMV is basically attributed to the other bets that they have going. Uber Freight, the scooters business, any kind of like new different mobility services like drones and things like that. I don't think there's any revenue there. But point is, they're becoming a platform conglomerate, and Lyft is just really focusing on being a ride-sharing platform. Right. Very different structure of business and scale, and just way that, if Dara is focusing on the bets that he's making and how he's allocating capital, it's a very different environment than a Lyft. Do you think that puts any of them at a certain advantage or disadvantage?
You typically see that with the dominant player going into multiple businesses. If you're in a second place position, you tend to not have the ability to expand beyond that, simply because you're just fighting for market share. I think so that indicates to me that Uber feels pretty confident in its position in ride sharing, and certainly domestically. I think the other thing that does is creates these kind of interlocking network effects, particularly for drivers in the Uber Eats example, where I might not be able to get a ride right now, but I can go deliver food. So it gives you kind of different opportunities to make money in the platform. And I think that only strengthens their ability to keep that supply in there.
Yeah, look, I'm pro Uber, right? I'm long Uber. I think it doesn't mean I don't think Lyft is going to do fine and will break even and will be a profitable business, which I've heard some people say they don't think Uber can be profitable. I don't believe that for a second. I think you can have a fine, profitable ride sharing business, even if you only have 30-ish% market share. Lyft is saying they have 40% market share today. Even if that comes down, I think they can still eventually, there's still a lot of growth in general in ride sharing in the United States. And I think they can both have a profitable, fine, growing business that if you look at their stock price today, will still make the average investor a fine earning on that investment. But I think if there's who is going to be the winner or who has more kind of upside to it looking forward is Uber. For that reason that they are moving into platform conglomerate status, and they're going to be able to use these different network effects from Eats and other things to just further lock in their both consumers and producers. But also let's look at the numbers here. And the numbers have honestly been a little bit confusing to me. And here's why. So we have done a lot of analysis on platforms in Platt, in the ETF, looking at Bloomberg data, looking at eMarketer, e-commerce market share data. And basically the concept of GMV, gross merchandise value volume, is not properly understood by the analysts, by the investment community. And I think part of the reason for that and part of the fault lies on the actual platform companies for not being as open or transparent as they should be with GMV data. So Lyft pre-IPO was disclosing their GMV. Then they said, hey, once we go public, we're not going to disclose GMV to you anymore. We will disclose to you our contribution margin, which is essentially, hey, if we do $1 billion in GMV, how much revenue do we get on that billion in GMV? Is it maybe $200 million? So they're going to have some take rate on the billion, and that's contribution margin. Their contribution margin for their previous quarter was $384 million, and that grew 174% from that same quarter the year prior. So year over year growth, 174%. That's a lot of growth. Here's the problem with only disclosing contribution margin. I don't really know why they had 174% growth. Is that 174% growth more a mechanism that they raise the take rate from 10 to 20%?
Right.
Or is it more a mechanism that they've been able to expand gross bookings?
Or they're reducing rebates and bonuses and that kind of stuff.
And I should know that as an investor. You're a public company. Your bigger competitor, by the way, is disclosing gross bookings.
Right.
And so me as an investor, that's a red flag to me. Why are you taking away this very important data point from me as an investor to be able to make a decision? Okay.
It's very unusual for a marketplace business to not disclose GMV.
And then I dig deeper, right? And this is why this red flag becomes a much bigger warning sign to me. So $384 million in take rate. I don't know. Let's assume that that's 20% take rate, which I think is somewhat generous. I think many Uber drivers, and I have some friends that kind of have like little mini Uber driver businesses, will say that Uber is probably taking like more than 20%, maybe 20 to 30%. But they are calculating the net fee. So that's take rate plus like insurance fee and maybe like rider convenience or protection fee and taxes. And there's other stuff baked into that. I think purely if you're looking at what is the take rate, I think a 20% is a pretty safe assumption, conservative assumption. Right. So let's back that out. That gives you $1.9 billion in GMV. Now, for 2018, the full year of 2018, Lyft reported $8 billion in GMV. So usually, right, you have strong quarterly growth. If you look at Uber's quarterly growth here on gross bookings, it's strong quarterly growth, 20, 30, 40%, year over year growth here. These are strong growth metrics. So that doesn't mean that if you have 8 billion in GMV, Q4 for Lyft is at 2 billion. Let's say Q4 for Lyft is around, say, 2.3 billion dollars in GMV in 2018. So now if I'm trying to say, what is Q1 GMV for Lyft? And I know they've, maybe got $1.9 billion in GMV. They have another $300 million or so in linear revenue. Linear revenue from these ride-sharing companies would be attributed to, when you do Uber Pool, that's not booked as GMV, that's booked as actual revenue. Uber got into a whole snafu about how to report this properly, but they're booking that as linear revenue. So there's some mix. That's why the GMV number is so important. So let's assume that Lyft had the $1.9 billion in GMV from pure regular kind of ride sharing, and then another $300 million from like the Lyft pool, Uber pool, whatever Lyft calls it. I don't know. That would give them around, say, $2.2 billion in GMV. That doesn't seem like much growth to me, even if my numbers are off by $100 million or $200 million. If you're only growing $100 million in GMV or $150 million in GMV from Q4 of 2018 to Q1 of 2019, that makes sense why Lyft stops to disclose this number to investors, because the number doesn't look good. Let's look at Uber's numbers here, okay? Uber is doing $14.5 billion in Q1 GMV, okay? Quarterly, okay? Massive. Now, this is global. That's the thing we need to understand here. That's $11.5 billion just from ride sharing and GMV if you take out Uber Eats, okay? When you look at what Lyft is saying is that, $8 billion in GMV in 2018, we had 40% market share. So if it's a total $20 billion pie for 2018, and Uber doesn't break out exactly what their ride sharing is from the US market, but that's saying, like, is Uber doing $12 billion in GMV in 2018 in the US? Look at these numbers. Absolutely. Uber's doing $11.5 billion in ride sharing globally in a quarter. And then you say, okay, basically, are they doing at least 25% of their ride sharing GMV from the United States? Roughly. That's going to put them at, that would then fit with Lyft's number. I think that sounds low to me, in the sense that I think Uber is doing much more GMV in the US than $12 billion for 2018. I think Uber, they bought Careem for $3 billion in the Middle East. They do have a lot of GMV elsewhere in the world. I don't think it's 25% of their overall GMV is coming from US ride sharing. That seems low. And the US is a massive market for ride sharing, one of the most mature. This has been going on the longest, basically be like US and China. But now Uber has exited their Chinese business, and that was wildly profitable for them and absolutely the right decision for them to do. So to me, this looks more, I think Lyft knows that it's not, if it continues to show investors apples to apples numbers, Uber to Lyft comparison, they know it's not going to look as good.
Right. If it were, they would be doing it.
Right. And now that they're public, they know they're going to get hammered even more if they do disclose it. So now they're hiding this stuff. And I think when you look at the Uber numbers here, they're strong. When you look at Dara and you look at his leadership and you look at his experience coming from Expedia and you look at the investments they're making as a platform conglomerate and what that does to their positioning and just power in the ride sharing business, as we talked about when we first started this, I'm long Uber. Now, that's my financial analysis. Here's my personal anecdotal story as to why I'm long Uber. Okay. I was a Lyft guy. Why was I a Lyft guy? Because I'm a big Delta guy. Lyft had a partnership with Delta. And what I would find is actually, more people were on Uber over the past few years. And actually sometimes I get better prices on Lyft just because I think less people knew about Lyft and the whole thing. So I would go Lyft. I would get, some points on Delta. It was nice. Fine. Then Uber a few months ago came out with loyalty programs and said, buy an Uber Pass. And I will basically get rid of surge for you. I will guarantee you, rates on your most traveled routes, all this kind of stuff. I'm an Uber guy now. I get locked in rates. And then Lyft followed, maybe like a month or two later. on their version of the pass. And this is to me is just one example about how the dominant platform, now the platform conglomerate, is going to be able to, at the edges, right, of innovating, it's just going to be able to innovate a little bit faster. It's just going to have a little bit more resources, a little bit more balance sheet that they can use or muscle to kind of seed these programs, maybe lose a little bit of money in the beginning while they figure out the economics. But I don't use Lyft anymore. I just use Uber. And I used to love Lyft. And, it's nothing against the brand or anything. I mean, but it really just came down to the economics and then this program. Yep. And then they get you with, oh, you've been so great on Uber. Here's your coupon to go use Uber Eats, 15% off, and then they bake in all these other things. And that to me is just a great example about how they sprung me out of the Lyft flywheel and into the Uber. And so I think that's not just happening to me. I think it's a great example of platform, of being the number one player and how you can use that power to your leverage. Last point on this, Nick?
I think the leverage that Uber has as both the number one player and having all these interlocking ecosystems will definitely help them long term. I think the only place you would get into trouble is if they don't succeed in the food business. It's a very low margin business with a lot of competition, DoorDash and others. Mm-hmm. They may there is a future scenario in which they might decide, we're going to exit this business because we can't make money here. Mm-hmm. But short of that, I think that they're in a strong position.
Yeah. Okay. All right. So StockX and Goat, if you're not familiar with them, there's this massive secondhand marketplace that's been created over the past number of years, basically fueled by the phenomenon that you actually still have a lot of consolidation on the manufacturing side of things, right? There's Nike, there's Adidas, and then they have their own separate brands, and there's a few other sneaker manufacturers. Now the designer like Balenciagas and I don't know, all the, and Dior, all the French luxury design brands are getting into it. But I don't know, it's maybe 10 brand manufacturers making sneakers. It's still super consolidated. Marketplaces don't thrive in consolidated environments. We've seen that time and time again. But the interesting thing is the fragmentation is coming because they have these very limited release products, right, starting with sneakers and now moving into watches, which we'll get to. Limited release products. And then people, if you can buy them at retail, you can make money flipping them on the secondhand market just because there's so much demand.
A lot of collectors and people out there that want the latest edition of Jordans or past editions that are still in good condition. There's a huge market of kind of sneakerhead culture and collecting happening out there in addition to kind of the traditional, I want to buy sneakers to wear them.
Yep. So what's interesting is, Foot Locker put $100 million here this is in February of this year into Goat. I think it was a great decision by Dick Johnson, CEO of Foot Locker, to get into this space. Kind of surprised and saddened that other sneaker and shoe retailers have not done something similar. There's multiple players in the space beyond just Goat and StockX. They both, Goat and StockX, claim that they have $1 billion GMV run rate. I don't think they have $1 billion historical GMV, but future looking, they did at least $250 million in GMV in the most recent quarter, and then they extrapolate that out into the future. Great. Good for them. I think the question is, if you have two warring platforms of pretty good size, both with a similar amount of funding, how can you overcome the chicken and egg problem? And what could either of these platforms use to eke out ahead of the other one? Now, the one thing is that I'll start off with is the easy answer is here. Don't get hacked and have all of your customers' data get exposed to the black market of people buying your information, which is what just happened to StockX 3 days ago. The unfortunate thing with the way StockX handled this is they didn't proactively get in front of this and tell their customers. This was actually leaked to the media, or the media found out, published this article, and now StockX is saying, oh yeah, that happened.
Not a good look.
But what StockX was doing was prompting its users to change their information without telling them,
why?
Oh, we think we were breached and all of our stuff was just laid waste to. So Don't do that. That's not going to help you in the war. But we've talked a lot about the 7 strategies for solving the chicken and egg problem. And basically, there's monetary subsidies, there's product subsidies, and then there's kind of psychedelic subsidies.
Psychological,
sorry. It's it's only Tuesday. I'm sorry.
Those two, but they're more frowned upon.
Yeah, not in the US. So the two to me that stick out, and I know the GOAT has alluded that they're going to do some of this, is infrastructure. So if I buy stuff on StockX or GOAT, it can take me 2-3 weeks sometimes to actually get the sneaker.
Right.
So the fulfillment, the logistics, we've talked about how Amazon, this is the killer app for Amazon to give 2-day, now 1-day shipping. So a big thing of investing in the infrastructure, getting the third-party sellers to store those sneakers in my warehouse. I'll still let you fulfill your sneaker sale on the competitive platform. If I'm GOAT, I'll still let you fulfill it on StockX. But now the inventory is in my warehouse,
right,
and I can charge you rent and fees to do that. And now I just have better logistics. I can fulfill faster and all these kinds of things. So I know they're trying to do that, but I think that's definitely an area that you could differentiate.
That's something where the investment from Foot Locker might help GOAT going after something like that, because they have all these physical retail footprints. And if you could start to integrate that into that delivery experience, that might help.
Exactly. I think the other strategy here would be acting as a producer, where with Foot Locker's just relationships with these manufacturers, could you go and get some premium products,
right, some exclusives?
We saw StockX do a deal, which was started by Dan Gilbert, the owner of the Cavs and Quicken Loans and a bunch of stuff. Do a limited release with like LeBron sneakers a couple of years ago on StockX. Could you now basically do that same strategy, act as a producer, but just do that much better and bigger now that you have Foot Locker helping you and juicing those channels and those relationships? I think that could work. As a user of both of these platforms, I would say I probably give. I think GOAT is slightly behind, to be honest. And I think, for example, if I go to StockX app, they actually give me much more transparency on the transaction history.
Right.
So I can very easily see what are all the sales for this shoe, and it just looks, just by looking at that data, like a much more vibrant community and ecosystem. And therefore, if I'm a consumer, that means I should get a lower price.
I think for them, it's in the name StockX. They viewed it as basically creating a stock market for shoes and other kind of eventually luxury items, now like watches. Yep. So for them, that kind of price and transaction history and transparency is very much part of the value prop. Exactly.
So I can still view that data on GOAT, but I have to look at every specific size of shoe to see the sales. Which you never know. Maybe GOAT actually has the same amount of volume, but I just can't view it in aggregate across all the sizes. And then it just looks smaller to me on GOAT. But I just feel like, why are they hiding that? It feels like they're hiding the information. Maybe they are or aren't doing it deliberately. But you kind of get the feeling that maybe they're hiding this because they don't have as much volume, which means I'm not getting as good of a price. And it's less of this kind of, I feel like there's less transparency, which is more of a product critique than a platform business model critique. But I feel like that product critique is fueled by maybe some lackings in liquidity and not having as much supply that maybe StockX has. So, maybe they can solve it with acting as a producer and some of these monetary subsidies, basically a monetary subsidy to help fuel the infrastructure and logistics and fulfillment capabilities of the marketplace. We'll see. The interesting thing, the other part of the GOAT StockX story is now they're getting into things like watches. And here's the other part about the interesting thing with the watch industry. The watch industry is consolidating their supply chain. So you want to get a limited edition watch, you were able to go to a lot of these like third-party boutiques and get limited edition supply from a Paddock or an Audemars or, different, places. But now the Swiss watchmakers are saying, nope, I'm only going to sell luxury watches from my retail branded locations. And because what would happen, same thing is, my guy has access to limited edition inventory. Now I'm getting it at retail, and I could go then flip that on a secondary market for much more and make good money on that. Now what these watchmakers are saying is, no. I want to give that luxury. I want to give that value to my most valuable customers.
Right.
I, the brand, want to control which are my best customers. And I don't want them to have to know a guy and have some relationship, with a watch person to get basically, to save or make 20, 30, 50, sometimes more $1,000 buying a luxury watch.
It becomes like trying to get tickets to a good concert.
Exactly. So they're actually kind of cleaning up the supply chain, which in turn is actually even more of a boost for these second-hand marketplaces like Goat and StockX, because now they're coming from the store. And if you can, now if you can get it on the secondhand marketplace, there's kind of less of this opaque
kind
lack of
gray
transparent
market going on with, if I know a guy, I can get it kind of thing. That's going away. So the actual secondhand market where people who have owned these things and are reselling them, that might actually grow from that.
Right. And I still think one of these luxury Swiss watchmakers would be smart to dip their toe or do something like a Foot Locker did. Like if I could go now and get a luxury watchmaker to invest in me as well.
Oh yeah.
I mean, now this would start to get very interesting because it's going beyond just sneakers.
I think for the luxury watchmaker, that makes a lot of sense too, to have a piece of that secondary market, and you'd be able to, certify products. You'd be able to control some of the quality there and your brand, and you can also make a good chunk of change helping run that market.
Mm-hmm, exactly. So there's an interesting article about the Fed. So the Fed is, where did this thing go? The Fed is a platform. And why is the Fed a platform? Well, the Fed is basically doing an initiative to improve. Have you ever sent a wire and then that goes through basically the Fed? So the Fed has actually been a payment platform for decades. Probably might actually be one of the oldest platform businesses, maybe second to Sotheby's, which was just acquired by like Patrick Drahi, I think the guy who just bought Altice. And so now the Fed has announced they're going to basically do kind of a new and improved version of the wire system in the US to speed up money transfer times amongst different banks and these kinds of things.
Private banks have, I think, launched their own system that's supposed to basically, rather than the current system what the Fed has, which is doesn't do weekends, takes multiple days to settle, versus if you make a purchase on PayPal, like it's
instantaneous.
And there's no reason that the kind of backbone of our financial system couldn't get up to that standard. So what the Fed is basically saying is, I think the date was like 2024, so it's still a little ways out. We're going to create an instantaneous payment system like this. There were some banks that weren't too happy because you have basically a private system created by a consortium of the big banks that have launched, and they didn't want the competition. But the Fed basically said we need to create a new competitor to this. Otherwise, we can't just leave one private business owning this kind of key aspect of our financial system.
Right. So it'll be interesting how they roll that out. But yeah, it's an international payment platform that's been around for ages. I mean, the Fed does a bunch of other things.
Right.
But why does it take a day or two sometimes, especially with international transfer, to send money across the globe?
Legacy infrastructure, really.
Yeah. Why can I only have, I don't think it's 140 characters, but there's some character limit, kind of like what Twitter had with SMS. Same thing on the notes that the memo you can put in your.
Why can't transactions settle on weekends and all that kind of stuff? It's about updating the platform and creating the infrastructure to support that.
Yep. Okay, so let's talk about food. Let's talk about Amazon Go. Amazon Go has been out for a few years now. Cashierless. I have cameras in the ceiling. They watch you. You pick something off the shelf. Boom! It knows that you just picked this thing off the shelf. Amazon Go, I think, is a groundbreaking transformational technology for the retail industry as we know it. A couple of reasons why. Lossage, especially in food and grocery in these industries. I think most grocery stores expect like a 3% lossage rate, which is basically theft and stuff goes bad, right? I take some produce off the shelf. I don't put it back into a refrigerated area in the store, but I don't buy it. That food goes bad. I got to throw it out. So there's all these kinds of, that was really just kind of a logistics and operational thing. There's obviously some produce that just doesn't get bought and then that goes bad. But the grocery business is such a low margin business to begin with. 3% lossage is a pretty big deal.
Yes, very big.
So presumably Amazon Go would cut down on that, because if I take something off the shelf and I don't put it back where I got it, it considers that a purchase. So you got to put it back where you got it, which then helps to solve that issue. The other thing are just square footage and the amount of square footage you spend on cashiers. And basically that all goes away because it's now all automated. And if you go into any grocery store in Manhattan, you will expect probably at least like a 20 or 30 minute wait time in a Whole Foods or a Trader Joe's or any of these places.
Actually check out.
Yep. Which is why I don't go grocery shopping in Manhattan. And then that's also why now you have, the Instacarts of the world and all these kinds of things. But if you can now, reduce the labor associated with having a cashier, make the retail experience fun and seamless where I don't have to wait to check out. I mean, you're now giving less labor cost, more square footage back to the store to use to actually stock products, to sell products, and making the experience better, seamless, faster, and more fun. It's a big win. Now, what has been reported is that Amazon is now approaching certain retailers to license this technology. Amazon has reported that they might actually have 3,000 of their own Amazon Go stores in the next few years. But Amazon's also not going to go sell everything under the sun. And there's certain industries that they just don't want to get into, maybe like certain clothes, or I don't know, certain industries that just
certainly not in terms of physical retail stores.
Physical retail, exactly. So now they're approaching some retailers off the record and saying, hey, would you want to license this technology? And the retailers are saying, oh my God, I don't know what to do, because this is the last piece of data that Amazon doesn't have access to. What am I selling in my store? But if I don't have a competitive solution, I'm going to be in big trouble, because eventually consumers are going to want this experience.
Right.
Consumers are going to want the experience, A, and B, look at what it does to the economics of my store. Also, if you sell clothes, lots of lossage through theft for clothes, big expense for clothing retailers. So pretty big deal. Now, there's a report recently about different retailers that are trying to take this on. Walmart's trying to take this on and do their own cashierless thing. Tesco was just in the news, this UK grocery store, which is trying to do its own thing. And basically, Tesco's working with a startup. I think Walmart's trying to do this in-house, maybe. There's reports that Microsoft is developing an Amazon Go competitor. That was from last year. PayPal, I think, is developing an Amazon Go competitor. Why aren't Visa, MasterCard, and Amex developing an Amazon Go competitor? When I think about, and they're also platform companies. To me, those are the players that should really be in the space. Those are the players that should, A, see this as a threat, and B, have the relationships with the retailers and really have an ecosystem approach where they integrate with a lot of different vendors.
I would say I'd be surprised if they haven't thought about it. I would guess that they have. I think that they might not be ready to take it public the way Amazon Go has. So Amazon certainly has an advantage. Mm-hmm. But if a PayPal is looking at this, I know Alibaba and Ant has looked at this in China. I would assume that the big payment platforms in the US have also been looking at this.
Yep. Okay. So continuing on with food. So the food distribution industry, interesting space. This is kind of on the flip side. We're not talking about B2C anymore. We're talking about B2B. As of 2015, there was an estimated 16,500 food service distribution companies in the US with about $270 billion in revenue. It's a massive industry. The biggest players here, you can see Cisco, US Foods, PFG, Gordon Food Service, and the list goes on.
Fairly consolidated at the top. Right?
Cisco and US Foods tried to merge a few years ago. That got shot down.
Yep.
Definitely the strongest number one and number two players. But there's so much fragmentation in this industry, and especially with the fresh products in the space. I mean, it's very hard to actually, I feel like, have the traditional B2B distribution model cater to the needs of all the different customer groups, particularly the smaller customers that have a lot of maybe different new needs, or particularly like local needs, maybe more gourmet, fresh food type of needs.
And I think the other issue there is price transparency. A lot of these distributors don't have very transparent pricing. So what I do as a customer, if I own a restaurant, I'm going to have a few of these guys that I'll reach out to and try to get prices. And, if I feel like one guy's not giving me a good price this week, I'm going to go switch it up. So there's this lack of transparency in the market that creates fragmentation, because basically if I'm operating a food business, I'm going to want a stable of these guys to serve me, because if it's only one, then because of that lack of transparency, eventually I'm going to get taken advantage of.
And a principal here, at Applico, Tree Tran, founded Munchery, a platform for food delivery, meal kits, and the sort. Penned an article in TechCrunch last year about this same opportunity, where we are seeing B2B marketplaces prop up all across the B2B distribution space. And so He goes into much more detail about how something like this could start with maybe fresh food or the like of it. Now, the interesting thing is that with Amazon obviously buying Whole Foods and Amazon Business being a top 20 B2B distribution player, this is a real thing. And Amazon Business is big in MRO and like medical supplies and different things like that.
They do food service too, but at the moment it's more like supplies and equipment, not fresh produce.
Right. And so I think there's going to be a convergence basically between the Whole Foods folks, the Amazon Business folks coming together and going after these big B2B food distribution places with a true marketplace approach. So that'll be interesting to see. The last thing on, basically what happens, whether it's a food distributor or now Cardinal Health, which I'm going to get to in a second, is they do e-commerce. And then they say e-commerce is a platform. Problem is, e-commerce is not a platform. We've spoken about this many, many times. Why is it not a platform? Because you're not letting in competition. You're not letting in the food space. That would be other small mom and pop food distributors or wholesalers. Right. That would be these mom and pop local, like fresh food, gourmet, maybe organic food distributors.
Often what you'll see is these companies, if they do let in third parties, it's like, let's partner with 1, 2, maybe a handful of these distributors that cover stuff that we don't cover. So, we can get a handful of more SKUs and different types of products, but you're not really getting that marketplace value prop. We talked about this last week with kind of this faux marketplaces you've seen in retail. You started to see companies looking at this kind of stuff, doing similar things in food distribution. No one's really gone after this marketplace opportunity.
Yeah. And if you're the big B2B distributor, that means you need to open yourself up to oftentimes some of your fiercest competition, which are the small,
on a local level, certainly.
Yeah. Mom and pop distributors and wholesalers. And that can be scary, but the problem is it's inevitable. And if you don't do it, literally Amazon's already doing it. Or eBay, Walmart, and Alibaba, depending on the vertical that you're in.
Walmart would be one to watch there, just given how much food makes up a portion of their 40% business.
40% of Walmart's business.
Grocery and produce. And that would be an area where I could see them definitely going into B2B because Amazon's not already there.
I asked Doug McMillan about this a few months ago. I said, hey, Doug, love what you guys are doing with marketplaces, yada, yada, yada. B2B is a big place. I think you guys should really get in there and don't let Amazon just kind of go bonkers, and they need some competition. And he looks at me, deadpans me, and he goes, it's great input, Alex. Thanks. And that was it. I mean, and then lo and behold, a month ago, they came out and said, oh, we're getting into B2B. So I don't think I gave him the idea, but they definitely are watching this space. And as we've talked about, I love Doug and Mark and the team they've got. So last note on B2B distribution here. Cardinal Health, not supposed to single out companies because I get in trouble, but I am. So Cardinal Health, one of the biggest medical supply distributors in the world of B2B distribution, are easily the biggest B2B distributors that are out there. Cisco's doing $50 billion. These guys are doing actually much more than that. Cardinal Health announces $137 billion in revenue. All of our 40,000 digital customers are using our new e-commerce platform. And our new e-commerce platform has, where did you go? Here it is. 300,000 products. I mean, you've got to be kidding me. 300,000 products. This is nothing. This is a drop in the bucket, particularly in the medical supply industry. I mean, it's a joke. Why do you even release this number? Don't release the number. Take it out of the press release. I mean, you know how much analysis these companies put into these press releases? Why do they release these numbers? These are pathetic numbers. I mean, Amazon literally has hundreds of thousands of just B2B sellers,
right?
Let alone SKUs.
Yeah.
These are the largest B2B distributors literally in the entire world of B2B distribution. And they're bragging about 300,000 products.
Well, I think it shows you the benefits of that marketplace model is that you can get way more breadth than you're ever going to get in just your own warehouses.
Those are the two value props of a marketplace and why marketplaces are inevitable in B2B distribution. One, widest product catalog. You give your customers the widest amount of choice. Two, the most pricing competition. If you have the widest product catalog and you have transparency on prices, it is naturally going to drive down prices and force other distributors, right? So this would be a Cardinal Health now opening themselves up to other small mom and pop medical supply distributors to post their own prices on a centralized product catalog. What do you think that's going to do? It's going to drive prices down for the end customer. The whole idea that I have a contract and I lock in rates, that's 20th century. 21st century is spot purchases. This is the industry lingo. But you know that whatever rate is on the marketplace is going to be the best price out there because I have such a competitive environment with hundreds or hopefully thousands and hundreds of thousands of sellers competing on the prices at all times. That's what customers want. Product selection and the best price. And if you can do that and deliver that, they're going to want to buy from you. And that's what the marketplace brings. And that's what these approaches just don't deliver. So it's unfortunate. I hope, I wish Cardinal Health all the best, but this is not the way to do it. Okay. And we're ending on that note. Have a good day, everyone. And we will talk to you tomorrow.